Hello and welcome to Econoday Unplugged on Tuesday, 4th of February 2020. Mark Pender is across the pond stateside, Brian Jackson joins us from Sydney, and I'm Jeremy Hawkins here in a post-Brexit London. Well, according to the Chinese zodiac, the 25th of January, welcomed in the year of the white metal rabbit, if I got my star signs right, is supposed to be the harbinger of good times for the Chinese economy. Well, the coronavirus, which has now infected around 20,000 people in at least 26 countries outside of China, is having something to say about that. On Monday and again today, the Chinese central bank was forced to make hefty injections of liquidity to calm local stock markets, while elsewhere, financial markets have been especially volatile, reflecting the fact that no one at this stage really knows how this will pan out. Consequently, just how damaging the virus could be to global demand and supply chains, all of which makes China the obvious place to start this week's podcast. So, Brian, what's your assessment of the impact so far, and for what it's worth, what's the sense of where things might be going?
Well, of course, the issue at the moment is that we don't really have very clear information about the scale of the problem, the length of the problem, the response to the problem. So I'm sitting in Sydney, and I don't pretend to have on the ground knowledge of how this is all going to play out. So I think it does mean we're just going to have to be a little bit patient. Of course, it's also exacerbated by the fact that at this time of the year we don't really have good information on how the Chinese economy is going, even in a regular sort of conditions, because of the Chinese New Year holidays. What that means is every year they combine all the January and February numbers together to try and smooth out the impact of the timing of the holidays, which differs year to year. And so we don't get any January data this month, and so we have to wait until mid-March really before we get all the official economic data for January and February combined. So the bottom line is we are flying a little bit blind at the moment about exactly what the economic impact of this is going to be. But I think we can be pretty confident that when those numbers for January and February combined come out in March, it's definitely going to show an impact on the consumer, on businesses, just given all the disruption that we have had. Just although the official numbers, as I said, won't be out to mid-March, we do have the PMI numbers, which is sort of put out by a private company, and so we have had that over the last couple of days. We've got manufacturing, I think it was out on Monday. We're getting the services sector this week. So that's really the only thing we've got so far. And what that shows for the Chinese manufacturing sector was that conditions did moderate at the start of the year, but nothing too sort of dramatic from where they were at the end of 2019.
Okay, what about some of these knock-on effects? If we take it back to your part of the world, we saw the RBA not making any change in interest rates yesterday, although it seems like quite a few analysts thought they would do. Now, what China is Australia's, I think it's right to say, easily their most important export partner. So are there concerns within Australia now that, if this coronavirus does escalate, that it perhaps could be one of the factors which ultimately forces the RBA to come out and cut rates?
It could, yes. I mean, China, I think, is about takes about a third of our exports. So, it's a big deal. I think at the moment, again, officials and business people here in Australia are sort of just watching and waiting and not overreacting to it. Obviously, we saw the Reserve Bank of Australia meet yesterday, and they actually seemed quite upbeat about the global economy. They sort of saw signs that things are improving, and I think they said that the softness in global growth that had been seen since 2018, the signs of it improving. They did cite the potential for the China virus outbreak to derail any recovery, but I think at this stage they weren't prepared to act on the risk that might happen. So if it does deteriorate, sure, they would be able to react, and I think also they're quite confident that the exchange rate will sort of do some of the work for them as well. So at the moment, they're definitely sort of in a holding pattern.
Okay. perhaps I was just moving across to Hong Kong then, because clearly we've got an economy here which was already in recession before. We saw a fourth quarter contraction again, and clearly that's before this outbreak hit in the first place. Obviously, we got the riots and so on, which will impact the fourth quarter. But presumably, Hong Kong must be really struggling at the moment and must be seriously concerned that we could see fourth quarter of a potential downturn there, really being exacerbated by what's going on as a result of this outbreak.
Sure. I mean, it's just been a terrible 18 months really for the Hong Kong economy. You started off with all the US-China trade problems. Then, the civil unrest there had a huge impact on domestic activity as well. And now you've got this virus issue. Earlier on this week, we had the first fatality recorded in Hong Kong. So, there's just not a lot of grounds for optimism about conditions there in the near term. We are going to have the government deliver its budget in the next few weeks, and so I expect that they will try and provide a bit of a fiscal support to households and businesses in Hong Kong. But it's still, I think, going to be a pretty slow recovery from the hits that the economy has taken over the last 12, 18 months.
Yeah, sure. Okay. Anything else you want to raise from your part of the world?
I think just India is also worth mentioning. We have the Reserve Bank of India meeting later on in the week. I think the consensus is that they'll stay on hold, which sounds right to me, because we do have a kind of interesting situation in India in that last year officials there were just really worried that inflation was too low. They have a target range of 2% to 6% for headline inflation, and they're always aiming to get it to around the midpoint of that range, 4% over the medium term. But last year we saw headline inflation really stuck at around that 3% level for several months, and in response, it was quite an aggressive series of rate cuts by the Reserve Bank of India over the middle part of last year. 135 basis points in total. But what we've seen is that as these rate cuts begin to flow through into the economy, there's also been a surge in food prices. So inflation, which had been, worryingly low for officials just 6 months ago, has now jumped pretty sharply over the last 3 or 4 months. And it's sort of actually moved past that midpoint, 4%, to the top of the range, and then through the top of that range to 7.35% in December. So all of a sudden, officials have this situation where inflation is above where they want it to be pretty quickly. Now, they will probably draw some comfort from the fact that it's mainly been food prices pushing up the headline number. Underlying price pressures look relatively steady, but I think it does mean that they're going to be very reluctant to deliver any more of those rate cuts, and at some stage they might even have to start thinking about taking back some of that monetary stimulus that they gave around the middle of the year last year.
All right. Brian, this is Mark.
Yep.
I have a question. You attribute at least a significant portion of the spike of inflation to monetary policy flowing through the economy. That is so interesting because other central banks across the globe have also been cutting rates, not quite as aggressively, but the RBI had a higher level to start with. Is cause and effect here actually demonstrating for us the risks of over-aggressive monetary policy? Is that what is that something that the RBI itself or policymakers there?
No, I mean, I think the rate cuts definitely have contributed to it, but as I said, it sort of happened right at the same time as there was a surge in food prices. So it's hard to disentangle those two impacts, and because food is such a large weighting in the headline inflation numbers for India, it's a larger weighting than in most other, in more sort of developed, advanced economies. So, I wouldn't sort of put too much into that just now. We know that sort of monetary policy does have a bit of a lag before it really flows through into some of those numbers. So I think the food price surge is probably the main thing that's pushed up that headline number. But yeah, there's no doubt that the policy relief is also going to have an impact, both over the short term, but probably more likely over the medium term.
Were there any special factors behind the food price surge?
Off the top of my head, no, I don't. I mean, it was mainly sort of the staples, the vegetables, the main parts of that food category, and there's also been a bit of an impact from fuel prices as well.
Okay, thanks for that, Brian. Mr. Pender, your neck of the woods then.
Okay.
Would it be fair to say we seem to be getting at least some tentative signs of a turnaround in the US manufacturing sector? Is it sustainable if that is the case? And I guess more immediately, does it bode well for Friday's key employment report?
I guess you're talking about the ISM report that we had yesterday.
I am.
That popped up above, out of the 40 range where it had been for through most of the second half of last year. It underperformed other anecdotal surveys, and there's quite a variety of them over here. But it's the most closely watched one, and I think it gets overplay in forecasters' views of things. But it was a positive, and there's other signs of the economy. Growth slowed quite a bit, especially in the manufacturing sector, and there are signs that began to improve perhaps at the beginning of the year. The economy consensus for manufacturing payrolls, which will be released Friday with the employment report, is for contraction, a 6,000 decline. And the other, and also part of that ISM report, and also part of the market PMI, which is a national level, not a regional level, which the U.S. has a lot of, showed declining backlog orders. And that's often tied with employment. The need for factory employment is tied to having backlogs to work down. And both those samples showed declines, outright contraction in backlogs, and slowing in one report in employment and actual contraction for factory payrolls. So maybe that little burst we saw at the beginning of the year was working down backlogs. And new orders, though, were very strong in the ISM report. We had factory orders this morning, and it was isolated to defense aircraft, the gains. But outside of that, it was pretty flat, with in core capital goods really looking weak, and that's not a good sign for business investment. So if business investment is going to be strong, the factory sector isn't going to have a very good year. It's still too early to tell. I think there is definitely malaise for the outlook, although some of these sentiment numbers, both on the consumer and on the business level, have been improving this over the last month. So maybe there will be an uptick in capital goods orders as the year unfolds.
Okay, fair enough. Hope then. What about the State of Union address tonight? Are markets got any interest in that, or is it just seen as a bit of politicking?
No, it's going to be a lot of politics. Yeah, there's a lot of politics going on right now. Of course, we had the Iowa caucuses that we're still trying to wait for the outcome there. And if I just want to say something about government policy, it's incredibly stimulative. Both the Democrats and the Republicans are spending lots of money, and we saw it in construction spending, for instance. That was released on Monday, and you could see like 17% year-on-year growth in government, in federal spending on roads, on the wall, and also local government. Very, very, like 11%, something like that. And so combined, this is a very significant amount of stimulus being provided to the economy. It's an election year, but this is the new world. We can print money, quantitative easing. The government can spend unlimited amounts of money, and it doesn't seem to be a political concern or even much of an economic concern. And it certainly isn't hurting the stock market. So,
okay, until it all goes wrong, of course. All right. Thanks, Mark. Right. OK, wrap things up with the Europe side of things then. And I guess it's still really quite depressing news over here. Kick off with the Eurozone. Last week, we had the preliminary estimate of fourth quarter Eurozone GDP. And that showed growth of just a 0.1% rate on a quarter on quarter basis. That was down from 0.3% in the third quarter. Put that in perspective, not only is it just, well, awful in absolute terms, miserable number, but it's also the worst performance we've seen from GDP since the first quarter of 2013. And that was the last time we actually saw a downturn, an absolute contraction in total output. Annual growth now stands at just 1.0%, and that's a 6-year low. So if the real side numbers weren't bad enough to keep markets at least thinking about possible further central bank easing, then if nothing else, any kind of talk about an early hike in interest rates or tightening out the ECB really went out the window with the January inflation report. If people remember, we saw a surprisingly sharp jump in the narrow underlying measure of inflation in the Eurozone in November and December figures, up to 1.3%. That was from 1.1% previously, and the strongest reading we've seen in a long while. Well, all of that was reversed in the flash numbers for January, so we're back down to 1.1%, which essentially just means that the underlying trend remains solidly flat. Inflation now is really no different from where it was in underlying terms and compared to a year, almost 2 years ago. So all this idea that, well, perhaps at long last we're starting to see some kind of acceleration coming through in Eurozone prices, well, it doesn't seem to hold too much water at the moment, which means that when we get into the next ECB meeting, that'll be on March the 12th, it could well be that the tone's going to be a little bit more downbeat than we've seen of late. And it does seem, at least for now anyway, that they'll be looking to retain their at least easing bias, as in they're still see their economic risk assessment being on the downside. Away from the Eurozone, as far as the UK is concerned, of course, we had Brexit happening late last Friday. But as we talked about before, it doesn't actually mean a great deal at the moment, in the sense that we now enter this transition period where they'll be entertaining these trade negotiations through December time, during which period the UK will remain both in the EU customs union and part of a single market as well. However, what does it mean in terms of big picture stuff? Well, if you think about the EU now, it's shrunk by one country down to 27 from the 28. And potentially more importantly, in terms of the likes, trading power and the overall size of the economy, it's lost 15% of its GDP as a result of the UK pulling out. So that's around about, 2.4 trillion euros or so. So it is a fairly major hit to the European economy, continental European economy in itself, and something to bear in mind in the future. More important, I suppose, more immediately.
Sorry, Jeremy, just on that.
Yeah.
We'll I guess there's going to be a lot of work then in adjusting sort of GDP numbers for the EU and other economic data. Has there been a lot of work sort of talking about how we should be interpreting EU data going forward with the UK no longer there?
Yes and yes. Well, kind of yes and no, I suppose, to any extent. Yes, I mean, clearly you're right. They're going to have to adjust for EU data. But having said which, they actually started releasing figures for EU excluding the European Kingdom, United Kingdom rather, a couple of years or so ago now. So in many ways, they've been preparing for this for some considerable while. And of course, as far as financial markets are concerned, they really look at the Eurozone data. And because the UK was never part of the Eurozone in the first place, fortunately, that's something we don't have to worry about. But yes, it does mean just in terms of the EU numbers themselves, they will be that much more different now, simply because the second largest member of the EU ain't a member of the EU anymore. More immediately ahead, though, it is worth bearing in mind that although Brexit may have happened officially as of late last Friday, markets will be looking very closely at how these trade negotiations go. And so we saw a fairly sharp sell-off of the pound early on out of UK trading this morning. And that was on the back of the hardline approach being adopted by Prime Minister Boris Johnson, who's already trying to lay down his idea of what sort of trading relationship he wants with the UK. with the EU, what he's prepared to give away, which isn't a lot, and what he's not prepared to give away, which is quite a lot. So already we're back into this kind of fractious negotiating stance between the UK and the European Union about what's going to happen in the future. And clearly, as far as financial markets or sterling investors are concerned, they really want to see by the end of this year a trade arrangement which effectively leaves the UK as closely aligned and trading freely with the rest of with the European Union as it was when the UK was part of the Union itself. The danger is, if you take Johnson at face value, that we don't get anything like that, in which case it starts, if you like, moving towards what markets used to call a hard Brexit, and that would be bad news for the pound. It'd also be bad news for the euro, and that could certainly be something which would trigger a move into alternative major investment currencies like the dollar and certainly the Swiss franc as well. What else should I be mentioning? I think probably as far as the UK is concerned, not really a great deal at the moment. In terms of the numbers, as we touched upon last week, Bank of England didn't do anything last week. They did, though, really manage down their risk assessment view of the economy. They no longer seem to be so committed to the idea that interest rates will have to go up, because they're now basically saying that, well, look, we've had some decent survey data for January, which has given the justification to leave interest rates where they were last week. But if the survey data aren't mirrored in the hard data, then they may have to come out and cut interest rates. So in other words, I think it's fair to say, as far as their kind of forward guidance goes now, it's switched from being really towards a tightening bias to a much more neutral bias. And that's just a reflection of the fact that they don't really know what's happening to the UK economy at the moment. We're going to have a very poor fourth quarter number for fourth quarter GDP next week. But first quarter at the moment, it looks as if it will be okay. But that's purely and simply on the basis of a soft survey data we've had for January and not much else. Okay, I think that's probably it from my side. Has anybody else got anything else they'd like to chip in before we finish?
Yes, well, you just said you almost diminished the importance of the survey data, right?
Oh,
but the Bank of England seemed to react to it very strongly.
Yeah, I wouldn't diminish it in the sense that, I mean, for a starting point, markets love survey data because it's up to date and normally beats the official hard data released by a week, 2 weeks, if not even more. So I think you've got to look at the survey data because asset prices are going to respond to it. The thing, of course, with the surveys, that sometimes they work well and sometimes they don't. But yes, I think you're perfectly correct to say that markets were thinking about the possibility of a cut in interest rates last week. The fact that the bank didn't do it at the end of the day was that they've given credence to the survey data and kind of putting on the back burner the fact that the fourth quarter hard data have looked pretty horrible. So I wouldn't dismiss the survey data by any means, but of course, as you say, from your side, I'm sure the likes of the PMIs and for us for CBIs, the surveys and so on, they're normally pretty decently correlated with the likes of GDP or sales over the medium term. On a month-on-month basis, though, they can the correlation can be pretty lousy sometimes.
Mm-hmm. Well, we have the ISM. As we even started talking about that. That's very important here. That's just a survey too.
Yeah, and it's got to be said, I think, if anyone who has the time to look at the official central bank communiques, or at least the full explanations of why they haven't done something, invariably the likes of the global PMI will be mentioned within the first paragraph or so as a kind of just broad-based summary assessment of what's happening to the international economy. And
they came out. They came out yesterday, right? The global manufacturing PMI, I think it was pretty much flat. About it seems to barely move at all, just hanging around 50.
Yeah, I think that's right. And again, I suppose this kind of idea, it's 50.4 if I remember rightly. And it's kind of this idea that, perhaps the worst for manufacturing is over now and there's reason for a bit of hope. But, again, it's kind of early days yet. We don't really know whether it's the bottom or else we're just, pause on the descent, so to speak. Okay, Brian, you happy? You finished? Anything else from you?
Yeah, all good here. Yeah, just
all good.
As I said, we're just waiting for further news about the virus, and hopefully, that'll be good, and they'll be able to get it under control pretty soon.
Yeah, we all hope for that. Okay, well, that's it for this week then from Mark, Brian, and myself. Thanks as always for listening. Don't forget to tune in again next week. In the meantime, remember, you can find all the key market moving data and events listed and analysed in Econoday's global economic calendar. We'll see you next time. Bye for now.